So thank you everybody for joining this webinar and panel discussion on the status quo and potential future of digital credit. So I'd like to start us off by providing some background on why we've invited you to join us here today. So Busara, with support from the Bill and Melinda Gates Foundation, has been doing supply and demand side research on digital credit. The digital landscape is huge with a lot of anecdotal evidence on how it works and how various stakeholders influence it. We have launched the Digital Credit Landscape Report, which will be shared by my colleague in the chat and is also available in the Busara Center website under the Insights section. Today isn't about taking you through the report, but rather is about hearing the perspective of stakeholder voices in the digital credit market and answering select questions from you, the audience, on the topic. So as we go along, please post your questions and comments on in the Q&A section, and we'll select some questions to put forward to panelists in the last 15 minutes of our session. Now, before we start with the webinar, I'd like to briefly summarize some key themes that emerge from the report. Digital credit products theoretically should be cheaper due to lower customer appraisal, loan distribution, and other operational costs, but this is not always the case. So we learned that the risk many digital credit providers are exposed to lead to high price points. The hope is that reduced risk will lead to lower prices. Cost is not always the sole measure of a product's appropriateness. People we spoke to told us about other attributes such as speed of delivery that make digital products good for them. We therefore need to think more deeply about how consumers appraise credit options. To understand the supply side perspective, we needed to follow the money and understand the funding landscape. More patient investors will likely be better for customers as they influence credit provider leadership towards lower costs. Banks are answerable to themselves. Therefore, bank-led digital products tend to be able to take on more risk and try new things without passing costs to the consumers. MFIs, microfinance institutions, on the other hand, are facing pressure to adapt to digital credit competition. We argue that this may decrease the necessary diversity in the credit market. And then the availability, sharing, and use of data will always be core in any conversation regarding the digital economy. Traditional data, which is mainly financials, so inflows, outflows, is still predominant. There, however, needs to be wider use of alternative data such as internet usage and psychometric scoring. Providers don't always have access to quality, traditional, or alternative data, and legal, infrastructural, and cost-related barriers need to be better understood and addressed. Data privacy policies are increasingly giving people ownership of their data through consent. We argue that this is a good thing, and we need to understand what data people are willing to comfortably share and how this data should be used and stored by providers. The repayment process is critical for both consumer and provider outcomes. We argue that the wider application of flexible repayment schedules will increase welfare, but more experimentation is required. We also learned that repayment schedules will often determine whether people use credit for productive purposes or not, given unique cash flow factors for micro entrepreneurs. Lastly, on repayment, digitally connected people, for example, Uber drivers, have very reliable digital records and have digital wallets that loan repayments can be automatically deducted from. There are some positives associated with this, but also some key consumer protection concerns around people's agency. Lastly, but certainly not least, we wanted to understand the gender gap, which is a significant challenge. Behavioral and structural issues result in a widening gender gap in credit provision and use. Part of the reason behind this could be that the data used to understand borrowers often has men overrepresented, leading to gender biases in credit allocation that do not seem obvious to providers and other stakeholders as well. MFIs have historically engaged well with women, and other credit providers can therefore learn about how to understand their needs and to better serve them. So today is the first in a series of webinars in which we'll discuss key questions on the digital credit market. Through this series, we'll be bringing together experts to give their assessment of bigger picture questions. Today, we'll be starting with an overarching question. What is the impact of digital credit? Please remember to post your questions and comments in the Q&A section as we go along. And my colleague from Busara Louis will bring some of them to our panel in the last 15 minutes. So without further ado, I'd like to introduce the panel who will be hosting this discussion today. And we can start with Aida. You can introduce yourself.
Thank you, James. Good evening, good morning, good afternoon. Thank you. Thank you for this opportunity, James and Busara. My name is Aida Sykes. I am financial inclusion. I currently work for IFC, leading a gender and financial inclusion peer learning platform. I also do some independent consulting on my own around innovation and sustainability, mainly around the startup and innovation scene on the continent, also focusing on gender and financial inclusion. My background is mostly the foundation is that of a banker, but I've worked with startups, and that is what put me on the path to private sector development, working with women-owned startups, working with e-commerce, working with ed tech. Moving to private sector development was a natural evolution to kind of get that overarching view of how it all fits together to improve livelihoods on the continent. Thank you.
Rafe, if you don't mind going next.
Yep. Hi, everyone. This is Rafe Mazer. I'm the project director of consumer protection with Innovations for Poverty Action, or IPA. We're a research organization that is currently leading a consumer protection research initiative, which is looking to develop new approaches or uses of things like administrative data, consumer surveys, and even experiments such as randomized control trials to identify what's wrong and what can we do to fix it with consumer protection in digital financial services, including digital credit. So thank you all for having me.
Ivan.
Good evening and good morning all. My name is Ivan Mboa. I am the East African Managing Director at Tala. Tala is a mobile technology and data science company that began 7 years ago, looking to leverage technology to solve the access to credit problem. And we started in Kenya, and since then we have expanded our model out into Asia and the Philippines, more recently in India, Latin America and Mexico, and also in Tanzania in Africa. Tala has gone on to serve well over 6 million clients, and in many of our markets, we are, if not the oldest, we're one of the most significant digital credit players who are really advancing financial inclusion for those who are traditionally underserved by banks and have Android devices. It's a pleasure to be here today, and I look forward to today's discussion and contributing. Thank you.
Thanks. And Jonathan.
Thank you so much for having me. My name is John Robinson. I'm a professor of economics at the University of California, Santa Cruz. And I'm an affiliate at the Abdul Latif Jameel Poverty Action Lab at MIT and the Center for Effective Global Action at Berkeley. And so I've been doing randomized controlled trials in financial inclusion, largely in East Africa, for about 20 years at this point. And for this panel, what's most relevant is that I'm co-director of an initiative at SIGA, which is about digital credit specifically. It's called the Digital Credit Observatory, and has funded about 15 projects or so in some form on looking at the impacts of digital credit. And so it's very complementary to the report in the sense that what we were trying to do is provide rigorous empirical evidence one way or the other on what the impact of digital credit is. I would say that initiative was motivated out of the possibility that digital credit might be harmful for people, could be beneficial, but could also be harmful given the high interest rates and so forth. And we're in we can talk about it more in the discussion, but we're in the process of writing up a report as well that I think will be very complementary to the Busara Center's report, focusing on a few impact studies that we've now seen that try to quantify the impact of digital credit on people's lives. So thank you for having me.
Thank you all, and thank you all panelists for joining. And we can get straight to a few questions. So essentially, the core question, like I mentioned at the beginning, is where does digital credit help and where does it harm? So I'd like to start with the question to Ivan is, what does Tala know about the benefits customers get from interacting with Tala's credit product?
All right, thank you very much, James. And so in terms of the benefits, I think I might describe them about 4 or 5 ways. In many ways, when we started, the majority of our clients, if they were looking for access to credit, had to go through traditional branch-based players, which meant that you actually had a significant delay between needing credit and being able to access it. So really the first benefit we delivered as Tala was this idea of instant credit when we started 7 years ago. Secondly, we also really pride ourselves on our accessibility, right? And not just logistical visits, but even in terms of the conditions. You know, we are an unsecured lender. For the majority of credit providers in this market and across, I think, most of the markets that the survey looked at, you typically find that most providers are going to ask you for physical collateral. Other benefits that our clients have come to us for in the past have been the flexibility, right? We provide flexibility to clients. Instead of a standard cookie cutter product, clients can really select the tenor that best fits their own cash cycles. So recognizing that some of our clients are entrepreneurs, in fact, 75% of our loans are taken for business purposes, but we also have clients who are employees. They effectively had to make sure that they can match their loan tenor to their next income cycle. We also have various sort of loan amounts that range, typically pretty small given the space that we're playing in. So it's about $10 to $300 equivalent. I think some benefits that clients get beyond just the size is also transparency, right? Unlike how it is when you're perhaps looking at a bank, it's very clear. You know, we have tried to really demystify this idea of, well, what is the cost of credit? Can I understand what I'm paying with in one go? Can I see all the fees? No hidden charges, no trying to calculate prorated interest. The idea of if I'm going to borrow X amount, it'll cost me 0.5X or something of the sort. And finally, I'll probably talk about the personalization, right? Which is using our machine learning models, we've been able to sort of design unique credit journeys for our customers, right? Which is to understand, when do we ladder up a customer? When is a customer ready to move from $10 to $50? When should we ladder them down again? How much should the client pay, right? How well the borrower has this client been versus another client. And so we actually have implemented risk-based pricing, which exists in this market where, effectively, if you have been a good borrower, your pricing can be a fraction of what, I'd say, a new borrower will pay. So at a high level, I think these are some of the benefits that I would mention that customers are really began to experience working with a digital credit provider like Tala as compared to incumbent options.
Thank you, Ivan. Perhaps you can transition to Jonathan, maybe to speak to, as far as the evidence that's been gathered so far on digital credits, on its impact. What can you share at a high level about what we understand or what the evidence says about the impacts?
Absolutely. So as I said, the Digital Credit Observatory funded a number of projects and take a very higher level or detached view, I suppose, of the possible effects of digital credit, and comes at it from the perspective, I think, largely from the borrower's point of view as to what is the, while it's also an interesting question that's also been touched upon about whether the products are viable and what default rates look like and things like that. I would say that the overall impetus for it was really more about the possibility of harm that could be coming from borrowers. And that's coming from the fact that though maybe it's a mistake to annualize interest rates when they don't necessarily compound over a long period of time. But when we're looking at interest rates of 10% over 2 weeks or a month, a lot of observers of the industry, especially those in like more developed countries where credit markets are functioning better, would look at those as astronomical rates. So there's been several studies that have been concluded. There's not many though, because these are projects. We're normally used to doing projects in which we can control. We give a treatment group like a treatment and a control group that stays apart. But here you need to work very closely with a provider. And so we have there's several studies that have come out so far. There's one that predates the DCO's work by Prashant Bhardwaj, Billy Jack, and Tavneet Suri, which is with the M-Shwari product in Kenya. And there's a project that I implemented with co-authors in Malawi with their product called Kuchova, which is a very similar consumer loan that's due in just about 2 weeks and has about a 10% interest rate. And there's a study with a smartphone app in Nigeria. And so these vary a bit in terms of whether these are bank or fintech backed loans and whether they use an MNO or not. They're very Africa focused, obviously. But I would say that so far what we found is that the impacts are neither negative nor positive, really. So there's no real, despite the many news articles that we've seen about predatory lending in countries like India and those sorts of things, we haven't seen in these studies, we don't really see major effects, maybe especially major negative effects for borrowers. There's some evidence of some positive effects, but it's pretty weak. So when you step back and look at it, maybe it's not that surprising that these loans would not necessarily be that harmful, because in some of these countries, like the one I'm aware of the most is Malawi, where I did the work, there are credit bureaus, but the provider's not necessarily reporting people to those. So and the default rate is pretty high. And there's not massive penalties to non-repayment. The loan sizes are small, like even much smaller than the TALA loans. And so maybe it's not completely shocking that there's not big negative effects of these programs. That's our current takeaway. On the other hand, I think James probably feels similarly. We only have a couple of studies from a couple of contexts, and one could argue that these providers that we're working with are like maybe on the higher end in terms of maintaining a brand and not being abusive towards borrowers, and so perhaps in other contexts these things would be worse. And then what was mentioned by Ivan just now is that the products that we've evaluated are really just consumer loans over very short time periods. And there's none of the products except that would be at all amenable to productive investment, because the time period of almost everything that was evaluated in the DCO is just a few weeks. So these are really short-term liquidity loans that are there for buying airtime in an emergency way, or maybe like there are a lot of people who buy food on even these small amounts of loans, but it's really not for farmers or for longer term investment. So it's very much just a very preliminary snapshot, but that's what we've seen so far in our first foray into impact evaluation with SIGA. Thank you.
Thank you very much. So I'd like to pose the next question to Rafe. Would you be able to paint a picture of some of the key risks that pose a threat to the welfare of low-income users, especially when using digital loans from a consumer protection perspective?
Sure. I think when we look at the risks, it's important to separate, what are risks related to sort of bad apples or bad actors, and what are maybe core risks of just the nature of digital credit or consumer credit markets in general. I think it's important because we get a lot of headlines on the bad actors when those might be a relatively small portion of the market, and it's important to take action against those. That I'm thinking here, things like fraudulent loan apps, that will maybe instead of Tala, they'll call themselves Talai and put an I at the end and try and trick someone that it's a legit app and you pay a registration fee and you never get a loan. And so those are fraudsters, which there are ways we're working with some researchers to use social media analysis and analysis of Google Play review data to develop predictive models to predict whether a fintech app is likely fraudulent or not. There's some key markers. And then you also have the harassment, which has come up here and there of certain aggressive, collections practices, either from a lender or outsourced, to a third party debt collection agency, which by nature, sometimes employs aggressive tactics because they earn their revenue based on the amount they bring back to the lender. And so that's more like, I don't think that's indicative of most actors in the industry, and that's more like a supervision enforcement issue. Then I think, on the kind of the core issues to me, it starts with this impact evaluation work, where, as John was saying, we're seeing, there's sort of marginal positive effect. And when that's the case, I think the long tails of impact matter more, right? And so I think about an analogy of, payday lending in the US, where before they intervened and set some restrictions on payday loans, they looked at how many times does a consumer roll over a payday loan? And most people only take it once, but there was a significant portion, I believe it was about 12, 13%, that rolled it over 10 or more times. And those are people who, once you roll over a payday loan with all those fees 10 times, you are really in a world of hurt in terms of debt stress. And so if the overall positive impact is relatively small, we need to care more about the long tail, about those who may get into debt stress. And when we surveyed, for example, consumers in Uganda who took mobile loans, 96% of them reported they reduced, 32% of them reported they'd reduced food expenditures to pay back a digital loan. 68% had been late at some time and taken a big penalty fee. So I mean, that's just kind of a core issue of, I think we need better targeting. I would also like to see perhaps more of tighter supervision of salary-based or auto debit loans, because we know with government administrative employees in other markets, there's been that's a really appetizing thing for aggressive lenders, because it's rare you get fired from a government position. And so then you can aggressively push these consumer credit to people. And even if they get behind, you're just harvesting more fees each month. So I think we need to look at that. And then the final thing is, I think it's when you have reporting to the CRB, the Credit Reference Bureaus, the sort of threshold for assessing suitability and ensuring, probability of repayment is higher, because the negative outcome for a consumer of non-payment will be more significant. So those are my main thoughts on sort of the risks that we're looking at. And I think we're seeing some policy solutions starting to emerge to address these.
Thank you, Rafe. Another question that I had is around the growth of the industry. So I think we'll all agree that there's diversity in the types of digital credit products offered. So for example, the idea of auto debits and the standard short-term loan from apps or some partnership with MNOs. But I think also more importantly is there's also been greater diversity of people getting access to these loans. So as smartphones and basic phones become cheaper, we're likely to see more and more low-income people getting access to these loans. So maybe I can ask Ida, from private sector development perspective, what do you see as some of the other reasons behind these loans becoming so prominent in the mass market? And perhaps more importantly, what are the potential effects of wider use and general growth of the digital credit industry, and perhaps eclipsing some of the more traditional models of providing credit to people?
Thanks, James. I mean, in terms of their prominence, I always have to sense check myself and remind myself that for us in financial inclusion, these products have huge prominence. But when you zoom out in the wider society, most people still haven't yet accessed a digital loan. It's a subset of a subset, i.e. people who have phones, and then a third to a quarter of those, at least in East Africa, have accessed digital loans. In terms of the diversity of products, I think there's still a way to go. I think most digital loans that I know of are still very small ticket, very short term, and they do end up acting more like a consumer credit function than anything that's income generating, wealth building, and long term, which is what you want when you're looking for when you're looking at this with development eyes, right? I think when you look at it with startup eyes, it's exciting, it's brand new. Everybody's excited about that hockey stick of users and revenues. But when you look at it with development eyes, and even more so, I think with the lender's eyes, there's still a lot of question marks. So IFC is the private sector arm of the World Bank Group. And our sister organization, the World Bank, has a think tank, CGAP, which I think we would all know quite well. And CGAP has been tracking the development of mobile money and digital credit for almost a decade now. And what CGAP is finding is that there are serious questions around consumer protection, around transparency. There's still enormous information asymmetry between lenders and borrowers, and that can be a driver for some of these risks that are being faced. So, I mean, look, we know digital credit followed a few years after mobile money. It's a natural evolution. When you're transacting, when you're saving, borrowing is the next step. The simplicity, the effectiveness of money transfers seemed to be a logical leap to instant loans. But to Ivan's point of, yes, brick and mortar, incredibly tedious, hard to reach for the majority of populations in our part of the world. But was the answer instant loans, or have we gone completely on the other end of the spectrum? 10 years into digital credit next year, we have enough data to start asking these harder questions and to start shifting our view of digital credit from just this consumer short-term credit function to longer term. I mean, asset financing is a product that protects the lender because there's an underlying value to the loan, but it also focuses the borrower. If you borrow against an asset, you have a purpose, you have restrictions around what you can use the money for. If there's been some financial literacy and business advisory services, you have a bit of a strategy around what you're going to do with that loan. If the tenors and the repayment are matched with those activities, that's when we start to think about prosperity. I think at the moment, it's still that income smoothing that can still lead to reducing food expenditure. I think as Jonathan said, we know that that's what happens to pay these loans. To me, that defeats the purpose. Sorry to be a bit of a little cloud there, but I think that's where our organization is. That's what our research is telling us in terms of how we view digital credit.
Thank you, Ida, and thanks for that perspective. I'd like to take the next question to Rafe around the type of people who are using these products. So as we've covered, it seems like for most of them, it will be their first experience with any type of digital finance because traditional credit, as Ida and John have mentioned, was completely irrelevant to these people. But now there's this product that it's still maybe not as big as some of the figures might suggest, but it's something that's likely to be growing. And information becomes important so that people can understand what this product is for and how it's supposed to be used. So if I could ask Rafe, how do you see this interplay between first exposure to formal finance and people who may not have sufficient financial literacy and know how to use these products in a way that's productive and to reduce their own risk and so that they don't get to the point where they're having to reduce their food consumption to repay some of these loans?
Well, I think maybe first it's important to be realistic that we're sometimes swimming upstream against human behavior, right? Short-term bias and temptation is kind of real, and I think you'll never remove that permanently from our behavior. And I think that's part of where digital credit creates some risk, but it's also what is so great about the product as well, right? If you think about when we did our surveys and we asked people what are the factors they focus most on when they take digital loans, right? It's the ease of access, the speed, things like that. And so I think that but I do believe there are some little interventions we can do in the middle of the customer onboarding process that can help, even if it's just, a little bit of marginal improvement. So I've worked with lenders, testing things like, intentional friction in the menu, where you have to actively, actively opt out of viewing the terms and conditions page. And we saw a positive effect, and the lender updated their USSD menu to that effect. There also is some recent work in Mexico by our Alfredo Berlando, Sylvia Prina, and Michael Kuhn that found that delaying the disbursement of the loan by a few hours actually reduced default rates. So there's where you start to weed out some of the people who are maybe not thinking through the cost of the product, or maybe not thinking through the usage. And those are little things we can do on the margin. But then I think the other one for new users is just to push for simplicity, right? I mean, I think these are small products. They're short term. These are very basic products, at least the first ones you get involved in. So there shouldn't be complex or fee structures, right? I think this is where, whenever I start to see a provider with a really complex fee structure on a simple product, I start to, the consumer protection alarms go off. And so I think that's maybe one other thing we could do is think about standards for simple pricing, and like not permitting deceptive add-ons like term life insurance on a 30-day product, which I've seen before, right? Because those are ways to hide extra fees and confuse the consumer.
Thank you, Rafe. So I think we can all agree that innovation is a key way in which different stakeholders can mitigate some of these risks that are involved in the digital credit market. So Ivan, you had mentioned that Tala is an innovator in the market as a provider. So how do you see Tala's strategic approach to mitigating some of these risks, both to yourself and to consumers? And then I'd also like to ask you a double question, which is in reference to some of the core questions for this discussion, which is around women. So we observed a gender gap when it comes to the provision of loans to women for various factors, some to do with data and perhaps other biases that manage to seep into a less person-on-person type of dynamic and type of interaction. So yeah, those two questions. So how are innovations trying to mitigate some of these risks, and how do you see a movement towards closing this gender gap as a provider?
Sure. I'll summarize, I think, some of the most pertinent risks for digital credit providers is probably into three areas. One is the risk of, are we lending to the right person? Right? Do I know who I'm lending to? Second, do I have enough information to determine affordability associated with the credit I'm going to provide to my consumer? And then third, and this is what a lot of people focus on, is what happens if a consumer or borrower willingly decides to default, right? Despite the fact that I know them, I've assessed their ability to repay, but they just don't want to pay. So I think on the first, what a lot of fintechs are doing, and even we ourselves, is that we've had to either create in-house methods of identity verification. In the case of Tala, we're very fortunate that in Kenya, 1 out of 4 adults has already downloaded our app. So we have tremendous amount of data that exists around the sort of subset of clients that we want to serve. And so there are many ways, for example, to use network data to identify is someone who they claim they are. But I'd say the most robust way of trying to manage that risk really has been, to partner with telcos. Telcos, I'd say, especially those mobile money providers, sit at the apex of such critical information that can really help digital credit providers with that first risk. Telcos, of course, will hold both the identity of the wallet many times you're dispersing into. They will literally have even identity documentation belonging to the borrower. And that's really critical. So I think to whatever extent telcos can provide those services through to fintechs, it helps. I know that Safaricom in Kenya, for example, has recently produced a product called MZ, where they can tell you the age of the SIM card. And the reason why is that you usually find a lot of fraudsters will typically register a young SIM card, then immediately apply for credit, right? So that can often be a signal that you can incorporate into your own underwriting models. The second risk of affordability, and I think this is really where the rubber sort of meets the road, and it's at the heart of really the digital credit model, is that we're always trying to improve our underwriting methods. And so even we as Tala were trying to incorporate new data sources. You know, at the beginning, the majority of all the clients who applied for Tala loans had a zero credit reference background, right? They'd never borrowed with local providers. So we had to spend a lot of time creating alternative underwriting methods, such as looking at device data, looking at sort of loan questionnaire information and on sort of behavioral data that was associated with the client filling out a loan questionnaire, and network data, as I mentioned. But now, effectively, we're able to pull in data from other sources. So the Credit Reference Bureau, potentially looking at partnerships with platforms where some of our customers may be either customers, suppliers, et cetera. And so we can also validate, I'd say, income streams as well with the consent of the customer through alternative channels. So that's definitely work in progress. I think that short of digital credit providers becoming neobanks and where they can gain full visibility into the wallet of a customer, it's always going to be a bit tricky for us to really identify just how much can this customer afford to take in credit. Right? You need to really have the visibility that I think banks and telcos really have, right? Which is inflows and outflows out of a wallet, which can sort of proxy income, right, and expenditure. Then the third biggest risk that we have, right, which is, so I know who the customer is, I know their ability to repay me, but they just don't want to repay me. Traditionally, we did rely on Credit Reference Bureau and the ability to sort of list, willful defaulter. As some of you might be aware, in Kenya, that right was pulled away over a year ago. And so what you're actually finding is that it kind of goes back to the second challenge, which is we have found that as long as we can position the benefit of a client building a relationship, this idea that a Tala loan is not just a one-off transaction, but hopefully one of a series of transactions that you'll take. And we can also be better in choosing who to actually provide credit to. It helps reduce the risk of willful default. It will always exist. I think even banks will face it. But ultimately, without the stick of Credit Reference Bureau blacklisting, you really are left with a carrot approach, which is to really emphasize, well, this is what happens if you repay a loan. This is the benefits of relationship. This is how much your limit will grow. These are ancillary benefits that we can bring in. We can lower your fees. We can, potentially give you waivers. And that has been really instrumental in helping us, I'd say, address some of the three biggest challenges that a lot of us digital credit providers face today. And then touching on why do we see lower levels of sort of female participation in sort of digital credit? What's interesting is that if I look at our statistics, even as Tala, I typically see that 57% of our customers are male. So it means about 43% of our borrowers are female. And it's really interesting to think about, well, why is that the case? I would say that, I think that there has to be sort of a lot more study is necessary to really answer that question, because female borrowers, in our experience, have actually typically had lower default rates when compared to men. So they are actually even literally the best type of clients to lend to. But I think there's a question around either demand, there's a question maybe around risk-taking, if it's these sort of perceived digital credit providers as a risk as compared to more traditional, maybe rotational savings and credit organizations or MFIs that might be closer to them. We don't know, but we definitely see that, yes, even in Tala, we skew male, we skew young. At 43%, I think we are doing perhaps better than most. It is not representative of the population, but it's not too far as well in terms of where the sort of the gender ratio is in this population. I do think that this will not be the case. In fact, when I think about the future of digital credit, which I think we'll touch on later on, I do think that niche approaches that target women will be some of the more successful strategies that digital credit providers can actually execute in this market. Thank you.
Thank you, Evan. On this question, I'd like to present it to Aida. Is digital commerce, mobile money and everything has been seen as such a strong ally in the inclusive finance environment and getting more low-income people value-adding financial services. Unfortunately, from what we've seen in several markets from the data is not only is there a gender gap in several markets when it comes to mobile money and digital credit, but actually this gap is widening. So I'd like to ask you, Ida, what do you see as some of the reasons behind this from your exposure, from the kind of work that you do? And also, how could different stakeholders try and make small gains to try and reduce this gap as much as possible?
Thank you, James. And first of all, congrats to Tala. When we look at gender balance, anything from 40 to 60% of either any genders. So by that definition, you have gender equality at Tala. Congratulations. Look, in terms of why the gender gap in credit persists, it's a lot of the reasons the gender gap in wider financial services persists, why the gender gap in digital access persists. Women may not have the financial literacy to use some of these products. They may not have the confidence in these products. There may be risk aversion, especially to things like borrowing. There are cultural limitations around women as decision makers around household income, and particularly around some of the documentation and sign-offs that formal financing needs. Some of that is also just not having even the identification to be given formal financing. But women are still engaging with financial services. It's just through traditional means that are much further along in terms of digitizing. We've mentioned MFIs. In Tanzania in particular, we have Vikobas, which are savings groups. And these are overwhelmingly female. It's groups of women, I think, but the main category of Vikobas is like maybe 80% women. And so there's something to be said for approaching those entities with a digitization proposal. If you can assess their needs and present a value proposition, not a single product, but a value proposition that touches across all these different kinds of barriers, financial literacy being a big one, there's a world where we could see women rapidly included if you kind of meet them where they are. And look, a lot of what I'm saying is some of it is coming from a pre-COVID perspective. Around 2019 in Tanzania, there was a big push to address this gender gap by reaching women where they are, digitizing savings groups. Tanzania has registered MFIs and even savings groups. While they're not regulated by the central bank, they do have to be registered to kind of act as a deterrent to bad actors. Then the pandemic hits and a lot of the planning and resources around that has paused. And now you're having to think about regaining lost ground as well as moving forward some of these initiatives. And that could be a factor behind the growing gap. We know women at all income levels and all around the world have lost ground during the pandemic. So it's not surprising at all that bottom of the pyramid women have lost that ground as well. There are bright spots. We can talk about them when we turn to the future, when we talk about that. But I'd say that's why we're having this persistent gap.
Thank you, Ada. And I think one of the key focuses in the next few years for all of us as stakeholders is to figure out what could be done to close this gap, because it's not going to be an easy task. There's so many factors leading to it. And I think a concerted effort will help close the gap, because as I mentioned before, it's a gap that's widening, which is contrary to a lot of our assumptions about the momentum of digital credit and digital finance in general. So before we get into the questions from the audience, I'd like to ask each of our panelists to pick maybe just one or two market changes that are needed for the digital credit industry to reach its full potential, as far measured by its ability to transform or to maybe even not be negative for the lives of low-income people in different markets. So maybe, John, you can start us off with your perspectives.
Sure, yeah. So just our perspective, or at least my own perspective, is that is actually, I think, a little bit more positive than this, just because just in the sense that the products are being offered for profit by lenders, and they serve a small benefit to people. Like, so we've talked a little bit about some of the downsides, but in our data, people maybe they eventually have to pay back the loan, but they're also using the loan for food sometimes. Like we find that like 15% of loans are for food or for emergencies and things like that. So in my view, it's the products that exist right now, they serve a small benefit. They're not game changing necessarily for individuals, but have a benefit. The other thing I just wanted to highlight is that these informal sources of credit, one of the reasons why people take up these loans is just that the interest rate on a loan at a savings group is also 10% per month. It's especially for people that aren't familiar with the context. You just see astronomical interest rates are common even in these other the underlying credit environment. So that's why people are happy to pay these high loans. The other thing I wanted to mention is, to speak about the consumer protection, we had an intervention where we were very much convinced that these loan terms are negative for people, and we did an intervention where we explained to people, like using a financial literacy module, about how high the terms were and what the late fees were and stuff. And we found that less than a third of people can even know when the loan is due. But the amazing thing was that after we did that, it actually increased the demand for the loan. I mean, once people understood that it was 10% over 2 weeks, they actually felt that was better somehow, which was kind of mind blowing. So in terms of like the products that, in terms of moving forward, I think that like definitely the products that exist right now are not going to be, at least the ones that I'm familiar with, are not going to be ones that have long-term effects on people's lives necessarily. But maybe some of the products that Tala is offering might be an exception. Though I think that the ownership of a smartphone, I assume, is a barrier in the wider world outside of East Africa. But I would say that the clear thing is to get credit to people like farmers, to people who are much lower on the pyramid, because another thing that we haven't spoken about necessarily is that the people who qualify for the loans are very much on the high end of the income distribution. So in the country of, like in Malawi, for example, we're selecting people who are making, at least hundreds of dollars or thousands of dollars a year. So it's just completely, the vast majority of the population is completely ineligible for this. So it's just, I think someone raised the point about being realistic about what is possible. And I don't know if it's really that likely that digital credit is going to fill that gap for the vast majority of the population, but hopefully it will in the coming years. Thank you.
Thank you, John. I think that's a really good point, in that it needs to reach more people. But maybe I can ask Rafe, in terms of what market changes can you think of that can make digital credits more impactful than it is today?
I think the first thing is need sort of a level playing field in terms of rules. So in a lot of these markets, you still have a situation where you can have providers offering very similar products, and then they're regulated or treated in different manners. And I think that we've seen that, right? Kenya is the one that everyone's talking about currently, where there's hopefully a bill that will address some of these challenges where you might have bank-based digital credit, which is regulated by the central bank, others that were not regulated directly by any financial sector authority. And that's led to issues, regarding requirements for reporting of full file positive, negative to the credit bureau. And then on the other side, it later led to the removal of non-bank digital lenders from the credit bureau, which I think was had some unfortunate consequences in terms of ability to lend in competition. So that's the first thing we have to get straight. And then really I'm interested in two things: competition and pricing. So and I think they go hand in hand. And so I would like to see more aggressive push to increase competition and ability of consumers to switch. So think about if you are a consumer who's not on a smartphone and you're in a market where digital credit is tied to mobile money. You really don't have many choices. You can only borrow from the lenders who've been given direct access to the USSD channel and the mobile money platform, right? So you effectively are taking the more vulnerable or more marginalized segments of the population and not letting them access a lot of different fintechs. And so I think that we need to look at the structures of some of these markets and some of the commercial partnerships and see, is that creating anti-competitive issues like vertical integration across communications, across payments and into credit. And then I think also I would like to see greater access. I've been mentioned about the importance of verification of identity and that great new tool which shows the age of a SIM. I think we need, with these new data protection acts that speak to data portability, we need greater exertion of what the Australians call consumer data rights, your ability to take your history with one lender and share it with others in a real-time setting, so that each time you go to the market to get a loan, to consider who can give me the best terms. And it's not when you switch a digital lender, you're starting from scratch again with your credit history and you're getting a $1 equivalent loan when you had worked your way up to $20 for the other one, but because they don't share your credit information, the new lenders can't measure your risk at the same rate as the incumbent can. One last thing from our work with Competition Authority of Kenya, digital credit market inquiry, which will be out soon, is we saw a lot of people paying their loans back very, very early. And I would like to see some sort of either rules or agreement that it's not necessarily declining balance, but some declining balance principle for interest rates, where if you pay back early, you get a discounted amount. Some lenders are doing that. It'd be nice if that was a universal standard, because we'd see huge portions of people taking a 30-day loan, paying it back in one day. And when you take out a mortgage loan or other products, student loan, it's declining balance, and so the faster you pay, the lower your interest are. So I'd love to see some exploration of that.
Thank you, Rafe. Aida, you'd like to go next?
Yes, sure. So the question is, what is the one thing I'd like to see in the digital credit space?
Yes, changes that would transform the market in some way and make it better for consumers.
Sure. I mean, I agree with everything that Jonathan and Rafe have shared in general, but specifically, I would love to see a targeted gender lens for every type of digital credit that exists. So on the consumer credit side, what does a gender lens look like for short-term credit? On the asset financing side, what does a gender lens look like on that side? I mean, we've talked mainly about short-term credit, but we know that there are asset financiers in the market. There's, M-Kopa, the biggest, baddest, oldest of them all, but we're also seeing asset finance around motorcycles, around agriculture products. What does a gender lens look like there? Because those are avenues of wealth creation that exist right now. And it's really just taking a look and being like, how can this meet the needs of women? We know their priorities are always going to be increased household income, their own skilled building, their own capacity building, and risk mitigation. And then if this comes with responsible lending that links, purposes of loans to the profile of the customer, then you start to kind of just integrate gender very organically. It's not just an add-on strategy, it becomes a core part of every aspect of digital lending. Related to that, I think regulation needs to be moving very closely with digital credit. We know, at least in Kenya and Tanzania, when mobile money was launching 12, 14 years ago, the central bank kind of said, let this roll, and as we evolve, we'll be learning with you and making our policies evolve with you. I think we haven't seen as much of that around digital credit, and some of that has been seen as suppressing innovation, and it can bring other costs to startups, but we need regulation to protect consumers and ultimately to protect investors in these startups as well. So yeah, gender lens across all products and regulation for fintechs, and some of that could lead to that level playing field that Rafe mentioned. Thank you.
Thank you, Adam. Ivan, would you like to close this off?
Sure. So I think when I think about the kind of market changes that are needed for the industry to reach its full potential, I'd probably highlight three: visibility, segmentation, and accessibility. And I'll kind of go into detail. By visibility, I'd say today we're seeing growth in the digital credit industry being throttled back by our inability as providers to truly see the rate of indebtedness of digital credit consumers, right? And two factors have caused this. We've had the recent regulatory limitation to blacklist defaulters, which means that if I am a borrower and I'm defaulted with provider XYZ, but XYZ are not able to blacklist me, a new provider has no idea about my history with all these other providers. The second challenge is even where you can actually go ahead and provide information to credit reference bureaus, you see ununiform contribution of credit information by various credit providers. Even when we as digital credit providers could list, not everyone was listing at the same frequency, which often meant that some of the information that you were seeing in credit reference bureaus was stale. It wasn't necessarily timely. The second factor I talked about was segmentation. And by segmentation, I think as mentioned earlier, we are seeing a lot of saturation around the generic, 1 week to 4 week unsecured credit products, which is offered by about 95% of almost all digital credit providers in Kenya. And I think for the industry to really grow, we need to create segmented offerings. For example, it could be small business finance, as Ida mentioned, perhaps a lot more women focused and other sort of gender specific plays, or even youth focused offerings, right? To ensure that consumers not merely have access to any type of credit, but rather tailored, fit to their unique needs and purpose type of credit. And I think that'll really help the industry grow. And finally, I would say that we also need accessibility. And this goes to the point that Rafe mentioned, right, earlier about data portability. In Kenya, there are only 1 or 2 players in our market, namely telcos, that have an information monopoly that needs to be leveled through open API regulatory mandates so that consumers can grant full accessibility of their transactional history across all providers to any new provider that they wish to access services from. And once we see this in place and the information monopoly is leveled, right, I think it will ultimately drive even more innovation and robust underwriting across all providers, be it telcos, banks, and non-bank fintechs. So in summary, I say those 3 things. I think visibility, segmentation, and accessibility are the 3 pieces which I think would ultimately revolutionize digital credit.
Thank you very much to all panelists. So those are the last of questions that I have, and I know we're on time. So I hope we can stay on for just a few more minutes because we had a few quick questions, and I can hand over to my colleague Louis, who's I believe has selected a few that we can just do a quick round robin of question and answer before we leave. If you have to drop off, thank you for joining. But if you have maybe 5-10 more minutes, kindly listen in.
Perfect. Thanks very much, James. And yeah, we're kind of at time, so I'll keep this to just a couple of questions. Thanks everybody for asking questions in the Q&A. I think a lot of these have been answered really well already. Please do follow up with any further questions if you have any. But I'd like to pull out a couple that I think were really interesting and could be spoken to a little bit more. One question was on the impact of the Central Bank of Kenya regulation of the market and their new policy to deregulate lenders. And Ivan answered this from an industry perspective, but I was wondering if Rafe could speak a little bit more to kind of the purpose of this policy and the effect that it's having within the market.
Right. So the purpose of the original, so you're talking about the purpose of the new proposed, deregistering and licensing. Is that what?
Exactly. Yeah. The deregistration proposals.
Yeah. So I mean, I think as has been mentioned, in some markets where you have full, supervision, you've had just like a registration of digital lenders with some government agency. In Tanzania, it's a different ministry than it is in Kenya, from my understanding. And so the idea is, with this amendment bill, it would basically bring digital lenders, all of digital lenders, including non-banks, under the supervision of the Central Bank of Kenya. And so immediately as a regulator, one of your first processes is you need to develop a licensing framework. And so the idea is that those lenders, digital lenders who are now under their mandate, who are deemed not to meet whatever criteria are put forth, would be registered. And I think it's good exercise because it's been a bit too much of the Wild West. And as I mentioned, with some of the conduct you've seen, it's certain bad acting down in industry. And so if you now have a way to say, well, they are different because they're not licensed, I think that will help the industry in terms of reputation, and also it just will improve supervision, because I've been amazed when we do these analyses of these app stores, how quick the churn is in these markets. You can see in 6 months, like a 50% churn in terms of the digital lender apps that are listed in these different digital credit markets we've been looking at. And so that's a lot of kind of fly-by-nights that are not licensed. And so if you have a licensing structure, you could also then maybe reach out to Google and say, hey, if it says the financial service and you're going to put it on the Google Play Store in Kenya or Uganda or wherever, it should be licensed by us. And perhaps if you did send something like that, could be transformative in terms of getting those fraudulent apps, not all the way out, but reducing them a bit. So yeah, I'm positive on that because it's leveling the playing field, it's setting standards. And I imagine the leaders in the non-bank digital credit, from what I see from the Digital Lenders Association of Kenya, support that kind of process.
Perfect. Thank you, Rafe. I think in the interest of time, perhaps one more question. And Ivan, I want to give you the opportunity to add on to that if there is anything. And then as a kind of subsequent question, there's a very lively discussion going on in the Q&A around the value of financial education for customers. And I think in one of your answers, you mentioned that there are some efforts by lenders and by lending associations to address that. So we'd love to hear more about what's going on there.
Sure. No, I think Rafe nailed it. Nothing to add and add-ons. Let me jump to the second point on literacy. I would say without a doubt, financial literacy is one of the most critical investments that digital credit providers can make, because it just makes sense, right? If your customers are unaware of what they're taking, how much it's going to cost, they're likely going to default, right? So it's an upfront investment that has to be paid. And so we put our money where our mouth is. I'll talk about Digital Lenders Association in Kenya. In March, we've actually been hosting a series called Money March. And typically what it is that it's a social media campaign by all members where we do share various forms of financial education content, whether that's video, sort of short form writing. We as Tala actually even created financial literacy content within the app. So if you'd like, you can actually go into our app and embark on a learning course. It's a sort of short learning course, just to really understand how best to leverage literacy to use your Tala loan in a way that will actually benefit you. I do agree that you need to do more than just an association 1 month a year, or even a provider sort of putting this in an app. I think to whatever extent that we can even get this within the formal education system and the curriculum, to whatever extent that we can partner with other providers whom this is their core work, right? This would be better, because ultimately it's not just a problem for digital credit providers. I think you would be surprised at the levels of literacy for even bank loan holders, right? Ultimately, it's something that has to be done. That would be my summary point. Thank you.
Thank you, Ivan. Thanks, Rafe. I think in the interest of time, I'll pass back to James to close us out. But thank you to everyone for sending all your questions in.
I just want to say thank you all. Thank you to the panelists for joining this discussion. Thank you to all the audience members who joined, and we hope that you learned a few new things. Do go and read the report. And we're actually transitioning to, or at least I am, to this webinar with the DCO, and they're going to be having a related discussion around the impact of digital credit from a study in Nigeria. So I believe there should be a link that's somewhere in the chat. But if not, you can Google the Digital Credit Observatory, and they have an event going on that's sort of related to this. So hopefully it raises the interest in the topic. But yeah, without further ado, thank you all. Have a good evening. Have a good morning. And thank you. Goodbye.